If you are over 60 and you have money sitting in a retirement account right now, what I am about to tell you in the next few minutes could be the most important thing you hear all year. And I am not saying that to be dramatic. I am saying it because April 15th is coming faster than most people realize, and there is a specific IRS rule that is quietly hitting seniors across America, some losing $50, $60, even $75,000 they worked their entire lives to save, not because they did anything wrong, not because they cheated, but because nobody told them about this in time. Welcome to Smart Money and Retirement, the channel dedicated to making sure that after decades of hard work, you actually get to enjoy what you built. If you are new here, please subscribe right now, because what we cover on this channel is the stuff financial advisors charge hundreds of dollars an hour to explain. And we break it down in plain English every single week. Now let's get into this because the clock is genuinely ticking. Let's start with the thing that nobody wants to talk about at the dinner table. The IRS has rules around retirement accounts that are designed, and I want you to really hear this, designed to make sure the government eventually gets its tax money. For decades, you've been contributing to your 401k or your traditional IRA, watching it grow, feeling good about it. And the whole time, the IRS has been very patiently waiting. Because here's the truth about pre-tax retirement accounts that a lot of people either don't know or don't fully understand. That money was never entirely yours. A portion of it always belonged to the IRS. They just let you hold it for a while. And now, through a rule called the Required Minimum Distribution, or RMD, they are coming to collect. Here is how this works. Once you reach a certain age, and this has recently changed, so pay close attention, you are legally required to withdraw a minimum amount from your traditional retirement accounts every single year. As of the Secure 2.0 Act, that age is now 73. If you turned 73 this year, or you are already past that age and you have a traditional IRA, a traditional 401k, a 403b, or similar pre-tax accounts, you must take your RMD. This is not optional. This is not something you can defer because you don't need the money right now. The IRS does not care whether you need it. They want their tax revenue, and the RMD forces that distribution to happen. Now here's where the $75,000 figure comes in. And this is where people's stomachs drop, when they finally understand what's happening to them. Let's say you've been a diligent saver your whole life. You did everything right. You maxed out contributions, your investments grew, and now you're sitting on a retirement account worth, let's say, $1.5 million. That sounds like a great problem to have. And in many ways, it is. But the RMD calculation on an account that size, at age 73, can require a withdrawal of somewhere between $55,000 and $75,000 or more, depending on your account balance and the IRS life expectancy tables. That entire withdrawal gets added to your taxable income for the year, which means it could push you into a higher tax bracket. It could trigger higher Medicare premiums through something called IRMA, Income-Related Monthly Adjustment Amount. It could affect how much of your Social Security is taxed. One forced withdrawal creates a chain reaction that hits you from multiple directions at once. And if you miss the deadline, the penalty used to be 50% of the amount you should have withdrawn. Even after Secure 2.0 reduced it, you're still looking at a 25% excise tax on whatever you failed to take out. On a $75,000 RMD, that is nearly $19,000 in penalties, gone, because of a missed deadline. April 15th matters here in a very specific way. While the standard RMD deadline for most people is December 31st of each year, if this is your very first RMD, meaning you just turned 73, you actually have until April 1st of the following year to take it. But here's the trap that catches so many people. If you delay that first RMD to April 1st, you then have to take your second RMD by December 31st of that same year. 2 RMDs in 1 calendar year. Double the taxable income. Double the potential bracket damage. And with tax day on April 15th sitting right around the corner, if you haven't sorted out your RMD situation and filed correctly, you could be walking into a tax bill that absolutely blindsides you. Smart Money and Retirement has heard from viewers in exactly this situation. People who genuinely had no idea this was coming and opened their tax documents to find a liability they were completely unprepared for. That is heartbreaking. And it is preventable. So what do you actually do about this? Let's talk about real strategies. The first thing you need to do right now, today, is find out if you are subject to RMDs. Log into your retirement accounts, check the account types, and if you are 73 or older with a traditional pre-tax account, assume an RMD is required and verify the amount. Your account custodian is required to calculate it for you, so call them if you're unsure. The second thing, and this is a strategy that genuinely changes the long-term picture for a lot of retirees, is to look at Roth conversions before you hit RMD age. A Roth IRA is not subject to required minimum distributions during your lifetime. If you are in your 60s and you haven't reached 73 yet, you have a window right now to convert a portion of your traditional IRA to a Roth. Yes, you'll pay tax on the conversion, but you pay it on your terms, at a rate you can plan for, rather than being forced into a withdrawal at whatever rate applies in the future. For people with large retirement accounts, this strategy done correctly over several years can reduce future RMDs dramatically and save tens of thousands of dollars in taxes and Medicare surcharges over the course of retirement. The third strategy is a qualified charitable distribution, and this one is genuinely beautiful if you are charitably inclined. If you are 70 and a half or older, you can direct up to $100,000 directly from your IRA to a qualified charity. That amount counts toward your RMD, but it never touches your taxable income. It doesn't get added to your adjusted gross income, which means it doesn't push you into a higher bracket, doesn't trigger IRMA, and doesn't affect your Social Security taxation. You satisfy your RMD obligation and support a cause you believe in, all while keeping your tax bill lower. This is one of the most underused tools in retirement tax planning, and Smart Money and Retirement cannot stress enough how powerful it is for the right person. The fourth thing, please work with a CPA or a fee-only financial planner who specializes in retirement taxation, not a general tax preparer who does returns once a year. Someone who understands RMD planning, Roth conversions, Social Security optimization, and Medicare thresholds. The cost of that advice is a rounding error compared to what poor planning costs you over a 20 or 30-year retirement. Here is the bottom line. The IRS is not your enemy in this story, but they are absolutely indifferent to your situation. The rules exist, the deadlines are real, and the penalties are painful. The only variable is whether you are prepared or not. April 15th is not just another date on the calendar this year. For a lot of seniors, it is a moment of reckoning, and the difference between those who come out fine and those who take a devastating hit often comes down to whether someone warned them in time. Consider yourself warned. If this video helped you, or if you know someone who is approaching 73 or already past it and has never heard of RMDs, please share this right now. It could genuinely save them thousands of dollars. Like the video so that smart money and retirement can keep putting this kind of content in front of the people who need it most. And subscribe because next week we are covering the Social Security tax trap, another one that blindsides retirees every single year and almost nobody talks about until it's too late. That video goes live soon and you do not want to miss it. Take care of yourselves and take care of your money.